Receiving growth, income, and safety is the holy trinity of dividend growth investing. Watch this video for 2 stocks that offer all 3. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. In today's video, I'm going to cover 2 stocks that have been requested by subscribers to look at. And they're 2 stocks that I frankly am very interested in because I consider them very safe because they have low levels of debt in this high interest rate environment. They also have dividend yields over 3%. They all have investment grade credit ratings, and their stocks have become, or they're reaching fair value territory. As Mr. Valuation, you know I really like that. But as always, there's a reason why these stocks have come into fair value, and I'm going to be discussing that and more in this video. Thanks for watching. Let's start out by looking at RTX, which is a combination of Raytheon and United Technologies. And what I really like about this stock is it has a really good, long-term record of growth. You can see that the company, even the combined companies, have increased earnings at over 7%. They did struggle a little bit in December of 2020 in terms of an earnings drop of almost 44%, but they rapidly recovered and grew again. The company has an impeccable dividend record, and long-term, this dividend has increased by over 10% a year on average, or 10% a year compounded. So there's where you get the dividend growth, but you also get the high income. The current stock currently yields 3.11%. You can buy it at a 15.34 PE, earnings yield of 6.52%. Now, having said that, let me talk about this a little bit. I consider this stock very attractive, or becoming very attractive, but as you can see, the stock has fallen rather precipitously since May, from $96 a share down to its current $75.80 as of yesterday's close. All right, now, as always, as I said in the intro, there's a reason for that. And the big reason is, if you look at this stock in terms of what's happening to it currently, I want you to notice that analysts expect good growth going forward, 13 and 17%. Going to the forecasting calculator, they expect 4% growth for this fiscal year, which ends in December, but then 12.77% in 2024, followed by 17.25%. And this is a pretty widely followed company. There are over 20 analysts reporting for this year and next year, and then 16 for the following year. Now, the estimates have come down a little bit in recent times. As I mentioned, there's a reason for the stock coming down and starting to enter fair value. And that reason is very simple. They have their Pratt & Whitney division will foot the bill for the turbine disc recall on their very popular engines over the next couple of years, okay? And these engines are ones that power things like the Airbus A220s, and which is about 40% of new, motors or new engines, etc. So there's going to be some airlines are going to have to put some of these airplanes out of service for a while Pratt & Whitney fixes it, and Pratt & Whitney will be footing the bill for putting those engines out. There's going to be about 85% of the bill. And of course, a couple things I want to point out. It's not devastating for this company because they have a lot of growth in their pipeline, and that's why the analysts are still expecting them to grow. But this is going to be a short-term hit. And what I want to point out is when you're looking at a stock that's highly valued, trading at 20 multiples and plus, like it was in 2023 and 2020, and most of 2023, 2021 and 2022, a stock like this is vulnerable to any kind of catalyst that would, have, some bad news out there. So we've got the bad news now. We've got this recall coming up, and it will record charges of about $5 billion, according to Morningstar, to revenue, and about $3 billion to pre-tax profit. All right. But again, I think this company is capable of absorbing that and still growing very rapidly. Now, here's the rub. I'm not sure. If we look at yesterday, the stock closed up 30 cents. If I look today at what the stock is doing, the stock is up, another 14 cents. So maybe we're coming to where the stock is getting at a low valuation. Historically, rarely does it fall below 15 times earnings, as you can see here. So this is becoming a rare opportunity. Now, there could be some bad news coming out, though, as the reports of this recall begin to transpire. And as that happens, of course, you could also see some pressure on the stock in the short run. But nevertheless, this is a stock that I think should be watched. Again, it offers a 3.1% dividend yield. It has an excellent dividend record and record of growing their dividend. The stock only has 31.35% debt to capital. It's a $110 billion market cap, a BBB plus credit rating, which is just one notch below A. So I think Raytheon is one, or RTX, I like to still call it Raytheon. It's the combination of Raytheon and United Technologies. Does look like a very attractive company here. With Fast Graphs, you can go into the eternal links here and get into their website, and you can then see what the company does and see all the different products they have. And I would highly recommend that you do your due diligence on this stock before you actually invest in it. You can look at all the different divisions they have, all the products they sell, the F-135 engines, smart defense systems, sustainable collected flight, and so on. So there's a lot to learn about this company, but you can go into their website and learn as much as you can about what this company does. And as you can see, it's really an aerospace and defense company that looks quite attractive to me. The price may drop lower. You should be prepared for that. You know, we're seeing a stock that has come into fair value, and there's a reason for it. There always is a reason for it. But like I like to say, and I like to quote and give and credit Marty Whitman, the manager of the Third Avenue Value Fund, it's our job to determine whether we're seeing a temporary interruption in a great business or a permanent impairment of capital. In the case of RTX, I see it as just a temporary interruption in a great business. Now, when I'm looking at the dividend and dividend safety, I like to look at free cash flow. Free cash flow got negative in 2020, but it's kind of rebounded, and it's expected to grow going forward after they get through with this recall. So I like it from a free cash flow point of view, covering the dividend, and looking at it from a price to sales, it's now getting close. It's currently trading at 1.55 times sales. Its historical normal price to sales has been 1.51 times sales. So it's getting close, and this may be a good time to start building a position, or if you want to be more conservative, you might want to just put this on your watch list right now and look at it, or do a little bit of both. I think both should be done. The second stock we're going to look at is another one that was requested by subscribers, and this is FMC Corporation. And FMC Corporation is primarily in the insecticide business. That's about half of their business. And what's happened is their prime product, diamide, is coming off a patent, and it wasn't supposed to really be affecting them until 2026. But apparently some short sellers have reported that they're already seeing some stress on their patents already. And so that really put the stock in a free fall. But once again, I want to point something out. The stock was overvalued for much of 2022 and much of 2021, etc. When a stock is overvalued like this, it becomes vulnerable. The coming off a patent is expected to have a negative 16% hit on earnings in 2023, which obviously ends in December. But then we're expected to see earnings growing again going forward at a rate of about 17% and 14% in future years. So we have an opportunity to make a lot of money in this stock in the long run. Over the short run, there still could be some stress. I think the price has overreacted here. The company's BBB minus rated. It only has 38% debt. It has a blended PE of 11.45 and a very strong earnings yield of 8.66% and a dividend yield of 3.03%. If you look at their historical rate of dividend growth, it's been very high. But one of the things I want you to note about that is the company started paying a dividend in 2006. FastGraph illustrates that clearly. But it was only paying out about 13% or 10% of their earnings. We'll call it double-digit, low double digits. And then you can see in 2019, they increased their payout ratio. They almost doubled it. Okay, and that really created a lot of growth in the income. And since that time, they've been maintaining this 25 to 30% payout ratio, I'll call it. From a standpoint of being a dividend-paying stock and looking at it from a standpoint of operating cash flow has generally covered a dividend. It's actually breaking even on operating cash flow right now. From a standpoint of the company's free cash flow, is currently below the dividend. And again, that has a lot to do with the diamide. So that's a cautionary note that you might want to take a closer look at. From a price to sales point of view, it's trading at current blended price to sell of 1.75. It's normally traded at around 2 times sales. And you could see there were times when it traded a lot higher. In fact, a lot of times when it traded a lot higher. So this stock already looks like it's pretty well beaten up. It could be very interesting. It's now yielding over 3%. The stock is, possibly still in a downfall. So this is one you might want to really watch. It's down 1.6% today, in addition to where it's been down. So this is one that you might want to see it start to increase in value a little bit, or see the stock price starting to improve before you take a position. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Said, I hope you enjoyed this video. It was a subscriber request. This is my take on FMC and Raytheon. I think both of them look really attractive now. But again, nobody knows what the short-term prices are going to do. Not yours truly or anyone else watching this video or anybody else out there running money. The market can be very volatile in the short run. But now that valuations are starting to make sense for both of these really excellent companies with low levels of debt and dividend yields over 3%, you might want to put them on your watch list and start taking a closer look and do your research and due diligence on them. I think both of them are excellent companies. I think both of them have good long-term futures. But again, there's reasons why the stock prices are down. Thanks for watching. If you like this video, give me a like, subscribe to the channel if you haven't already, and take a good hard look at FastGraphs, the Fundamentals Analyzer software tool. I couldn't even imagine investing without it. Thanks a lot.